Are you a Web3 business owner transacting with digital assets? If so, you know how complex and ever evolving the regulatory world of taxes and accounting can be for cryptocurrencies. In this video, I'm going to go over the top 5 accounting and tax mistakes that I see Web3 businesses make and how you can avoid them or fix any issues they've caused. Watch this video and we'll go over 5 tips in detail. Tax evasion. There are still many cryptocurrency investors and business owners that believe that it's a choice whether or not you have to pay taxes due to the perceived anonymous nature of cryptocurrencies. This is the furthest thing from the truth. The Bitcoin is an immutable public ledger and it's not anonymous, it's pseudonymous, meaning that all a taxing authority has to do is tie an identity to your address and they'll have all of your transactions. So it makes no sense to believe that the blockchain or cryptocurrencies are going to be a good avenue for tax evasion. It's actually the exact opposite. So it's very important to make sure that we're capturing all of your activity across all centralized exchanges as well as across all non-custodial wallets. We want to make sure that we have all of your transaction data. That's what we're going to need to get an accurate cost basis and overall accurate calculation and financial records for your company. And in the event of an audit, your transaction records across all of your wallets and exchanges are going to be one of the first things that an auditor asks for. And it's very simple by tracking and tracing the flow of funds across the blockchain and across your wallet addresses if there's gaps in data that need to be investigated further. Treasury management is crucial for Web3 companies that want to be long-term players in this space. Each bull and bear cycle, I see this one mistake completely blow up companies and blow up investors. And that is holding potential tax liabilities in cryptocurrencies that you may be receiving as payment, or you may have had some capital gains when you transitioned into, and then you hold your tax liabilities in this asset that you received. What this does is it exposes the tax payments that you're going to have to send into the tax authorities either on a quarterly or yearly basis. It exposes these tax payments to validity risk in the market. And what can happen, and what I see each bull cycle after each bear run, is someone's holding their tax liabilities in, let's say, Ethereum. And when the price of Ethereum drops by 50%, they've effectively doubled the amount of taxes that they're going to have to pay in terms of Ethereum. So, if the price of Ethereum drops by half, rather than sending in 5 Ethereum for a tax payment, you're going to have to send in 10 Ethereum for a tax payment. Now, obviously, you don't directly send in Ethereum, but if you're holding your tax liability in Ethereum, you're going to have to liquidate that at the lower fair market value before you send it in for tax purposes. So at the very least, anytime you're earning income or anytime you have a sizable capital gain, you want to at least take the tax portion of that gain or that income and move it into USD or move it into a stable coin. Likely you should be paying estimated taxes on it. Inaccurate cost basis tracking is costing Web3 companies big when it comes to taxes. Tracking your cost basis as a Web3 company is a cumulative process. That means on a year-to-year basis, whatever your ending cost basis is for 1 year, in the next year, that's your starting point. So it's very important that you accurately track your cost basis from the inception of your company to its current point. If there's any inaccuracies in any of the prior years or prior months where you started your accounting, or if you started your accounting not from the beginning, maybe you skip the first year because the first year is light on activity and you start in the second year. If there's any gaps or if there's any classification issues into how you did your accounting, this is going to lead to a potential understatement in your cost basis or an overstatement in your gains and income, and can lead to you paying additional taxes. So, one issue I see with Web3 companies is many of them don't start from their earliest transaction, and they miss some of that early cost basis data. This can be because they may say, hey, I don't have a lot of activity in the first year. We just had some capital contributions, or we just had, a small amount of expenses or a small amount of income. Let's just leave that for later. Let's start on this second year where we really start to get going, where we really start to have a lot of income. If that approach gets taken, All of those assets that you received in the first year are not going to be on your balance sheet. They're not going to be in your digital asset subledgers. And whenever you go to sell those assets, there's going to be a negative tax implication, because if you received an Ethereum at $10,000 and we don't pick it up on the books, when you sell it or spend it, you're going to have a proceeds of, let's say, 10K and a cost basis of 0, when your cost basis should be 10K. So we want to make sure that we're tracking your cost basis from the very first transaction through your current period. And the key is that we need to do this accurately, because just like if we miss data, it's going to lead to cumulative inaccuracies that can follow you around in your financial statements for years. If you miscategorize something, the same thing can happen. So it's key that we start with the earliest transactions when your company first got started, and we accurately do the accounting through to the current period to avoid any cumulative balance issues in your digital asset subledger and or on your balance sheet. Commingling funds is a huge issue for Web3 business owners. What is commingling funds? It's mixing business transactions with other transactions that can be associated with another business, or your personal funds, family funds, or all of the above. This is very common for Web3 companies that are getting started. Oftentimes they'll come to me and, before they got their company started, they may have transactions that are taking place in their personal wallets that, have a business connection to it. Or they may have been they have a company set up and they're doing transactions for their business, but they're doing it on their personal wallet. And there can be, sometimes it's just for the sake of convenience. Sometimes there can be practical reasons on why you want to use a wallet that has a history associated with it for business purposes. But it's very important to understand that commingling funds can create significant accounting headaches as well as tax headaches, depending on your company structure and depending on the specific fact pattern on how exactly you commingle funds. So we want to really make sure that we avoid this. Once you establish your Web3 company, you want to set up institutional exchange accounts under that company's EIN, along with regular bank accounts under that company's EIN. And then you want to establish non-custodial wallets that are specifically dedicated to your company. And then those are the only places that you want to have business transactions take place. And within these business accounts, you do not want to have any personal transactions or any transactions from other companies. This is going to keep your accounting clean, and it's going to avoid tax nightmares. Are you a Web3 business owner looking for a reliable Web3 CPA firm that understands your unique accounting and tax needs? Look no further than Camuso CPA. We work 100% with Web3 companies and digital asset investors, and we've been in this space since 2016. Regardless of your tax or accounting needs and the complexity associated with your digital asset transactions, Camuso CPA has you covered. Contact me and my team today.